Okay, let's begin then. I'm assuming that you've all already been through the first workbook on the introduction to PFM and that you have the background to the course. So I'm not going to repeat myself on that. I'm going to go straight to Workbook 2 and go through the Workbook 2. And I'm going to follow the sequence and organisation of matters in the workbook. Okay, sorry about that delay. I thought I had the file available, but it obviously wasn't available. We've got it now anyway. So as I say, I want to go through Workbook 2 and the basic principles of accounting. In this presentation, we're going to look at some of the fundamental concepts of accounting, the nature of double entry accounting, and then the extended example that's in your workbook. The first problem that a lot of people raise is the difference between British terminology and US terminology. British and US accounting are exactly the same. There is no difference between them, except that sometimes different words are used to mean the same thing. So, for example, in British terminology, we talk about debtors. In the US, they talk about accounts receivable. Both mean the same thing. They mean money that is owed to you for goods that you've sold to someone else. And then the opposite of that, creditors in the UK, accounts payable in the US, amounts that you owe for goods that you have purchased on credit. And then one that's very confusing, in the UK we generally talk about shares in limited companies. In the US they tend to talk about stock. Whereas in the UK, stock is what the Americans usually call inventory. You can see it becomes confusing, and you'll very often find that even in the same textbook, people will use the same words in different ways. So you always have to be very careful that you are using words in a way that you understand. The second concept is the concept of the entity and the financial year. Accounting is about accounting entities. The UN definition of an accounting entity is an organization that engages in identifiable economic activities, controls economic resources, and is distinct from the personal activities of the owner. Now, that could be an individual businessman, for example, Ahmed & Co. carrying on a business. It could be a company, Company X Limited. It could be a non-profit entity, such as the University of Hargeisa. It could be a ministry, the Ministry of Health within the public sector, or it could be a government, the government of Somaliland. All of those are economic entities. The second point is that we will always talk about financial periods, usually the financial year. That is not always the calendar year. In Somaliland, it's the calendar year from January the 1st to the 31st December. But in the UK, for example, it runs very strangely from the 6th of April one year to the 5th of April the next year. The reasons for that are historic and don't matter, but it shows, again, financial years are not always the same as the calendar year. The third concept is cash. What is cash? And the definition used in accounting is broader than the everyday definition. This definition is taken from the International Public Sector Accounting Standards, and it is the one we will use consistently through this course. Cash comprises notes and coins, bank current accounts, and short-term, highly liquid investments. It could also include bank deposit accounts, provided that they can be accessed within a short period of time, usually 3 months. So when we talk about cash, we will be talking about it in the sense of this definition. And the fourth concept is financial reports. Financial reports have a very structured meaning, and again this is taken from the International Public Sector Accounting Standards. They comprise the balance sheet, The profit and loss account. For a public sector entity, it's called the operating statement or the statement of financial performance because public sector entities don't make a profit, but it's the same thing. It's the cash flow statement. And for the public sector only, a comparison of the budget with the actual results, what you expected and what actually happened. And then finally, it's the notes and accounting policies. In this workbook, we will be concentrating particularly on the first two, the balance sheet and profit and loss account, at least to begin with anyway. Double entry accounting. Double entry accounting is usually traced back to an Italian, Luigi Pacioli, who wrote a book in Venice in 1494, The Principle of Mathematics, which contained 30 pages explaining double entry accounting. He didn't invent it. As a matter of interest, it probably developed in India and was then further developed by Arab traders across the Mediterranean and was then adopted in Venice, a very powerful state at that stage, in 1494. You don't need to know the history, but what is important is the basic principles of double entry bookkeeping have not changed and still remain valid. It's quite difficult to understand the concept of double entry accounting, and we use 3 illustrations to try to explain it, although I think it becomes clearer when you look at the example we're going to go through. Basically, there are 3 types of items you have to be aware of: assets, liabilities, and capital. And any transaction or economic event will increase or decrease one of those, and will increase or decrease one of them on the other side of the transaction. Every transaction has 2 sides. The use of the terms debit and credit, which you've got there, is just a matter of convenience. They could have been made the other way round, but right way back in Luigi Pacioli wrote his book, it was decided that this is the way they would be used. The accounting equation is another way of looking at it for those of you with a mathematical bent, and we can say that capital equals net assets, which equals assets minus liability. That's the basic accounting equation, which is always valid. And finally, we can look at that with a very simple example. We can say that in any organization, it has capital of $2,500. By definition, that equals net assets of $2,500, which is further defined as assets of $3,000 less liabilities of $500. So that's really 3 different ways of looking at it. Some definitions of terms. Capital. Most students of accounting find the concept of capital very difficult to understand. And in everyday use, you'll find it's often misunderstood. It's defined as the owner's interest in the business, which is actually not a very helpful definition. Capital is not money. It can only be converted into money if you sell the business. Capital is the net assets of the business, and in fact, for public sector entities, you often simply refer to net assets rather than capital, or alternatively, sometimes you refer to funds, for example, the consolidated fund. They mean the same thing as capital. An asset can be a tangible asset, such as buildings or vehicles. It can be an intangible asset, such as intellectual property rights. Or it could be a financial asset, an account receivable, a loan that is owed to you. A liability, on the other hand, is something that is owed to someone else. For example, accounts payable, loans that have been made to you, or where you've been paid for services, but you haven't as yet delivered those services. That's a liability. You still have to deliver the service. I'm going to go through the extended example that we use in the workbook because I think that's a very good way of explaining how double entry works in practice. It's the way I learned double entry to begin with, and most students find this the easiest way to understand it. we look at the impact of a series of simple transactions on the balance sheet of a small business. Why a business rather than something in the public sector? Because it's easier to explain in the context of a simple business. Later on, we'll go and look at double entry in the context of governments and public sector entities. But for the moment, we'll look at, with this very simple business, Ahmed, who decides to start a telephone shop on the 1st of June. I made it 2018. It's 2013 in your workbooks, but I thought we should bring it up to date. Well, I just want to go through those transactions one by one and show how they're reflected in the balance sheet. So on day one, well, it's very simple. Ahmed has got $20,000 in his business bank account, and that is his capital. By definition, his capital is the amount of cash that he put into the business. His net assets are, in fact, only one asset, cash at bank. On day two, he acquires a motor van for the business. Now, what that means is that he takes $3,000 from his bank account and uses it to buy the motor van. So his bank account has gone down by $3,000, but his motor van has become a new asset at $3,000. Can you see the double entry working already? That's the two sides of the equation. Cash goes down, motor van goes up. Net assets remain $20,000, so capital is unchanged. And day three, he goes on to buy fixtures and fittings for cash. Again, the same thing. We now got a new fixed asset of fixtures and fittings of $1,600. Cash at bank has now gone down to $15,400, but net assets remain unchanged at $20,000. On June the 4th, he receives a loan from some generous friend of $5,000 in cash to help with the business. Now, of course, the cash at the bank goes up by $5,000 from day two, from $15,400 to $20,400. But that's balanced by a new liability of $5,000 for the loan. So the capital remains unchanged. The net assets remain unchanged, still $20,000. It is simply the composition of assets and liabilities that has changed. I hope you can hear me. I have to say my voice is not clear. It should be clear. This is a good internet connection, and I've checked that it's working okay at this end. So if you can't hear, it may be a problem at your end. I shall carry on speaking slowly and hope you can hear me. The distinction between fixed and current assets and liabilities is a new concept which we've now introduced. A fixed asset is an asset expected to be used by the entity, by the business that is, for more than 1 year. A current asset is an asset expected to be used within 1 year. And we also include cash and short-term investments in current assets as well. They're actually not used, but because of their liquidity, they're counted as a current asset. Current liabilities are liabilities expected to be paid within 1 year. So, for example, if you buy goods on credit, you'll normally be expected to pay within a few months. So they will be current liabilities. If a loan is repayable within 1 year, or part of a loan, then that is a current liability. Whereas if it's repayable beyond 1 year, it becomes a long-term liability. All of accounting reports use these distinctions. Later on, we will look at the IMF Government Financial Statistics Manual and find that they use a different way of classifying assets and liabilities, but that does not concern us at the moment. So the balance sheet on June the 5th becomes the motor van, the fixtures and fittings, and now we have some inventory. We've bought $9,000 worth of telephones on credit, so we've got an item of inventory using the US terminology of $9,000, and we have a creditor in the UK terminology or an accounts payable in the US terminology of $9,000. No change to the total net assets and therefore capital. So the size of the business is growing. The total assets are now more substantial, but the net assets remain unchanged at $20,000. Until June the 6th, when we have the first sale and profit. Profit is either the gain from selling above purchase cost, or the fees for providing a service. In this example, we made a sale of $1,800, and we are told that we've sold inventory which cost us $1,200, so we made a profit of $600. So we now have an account receivable, because we sold on credit, of $1,800. We've reduced the inventory by $1,200, the amount it cost us, and we have a profit of $600. And that's reflected in the balance sheet, so that the inventory is reduced to $7,800, but we have the new item, debtors, UK terminology, accounts receivable, US terminology, of $1,800. And if we look at the capital side, for the first time that's changed. We have a profit. That profit increases the owner's interest, $600. So capital goes up to $20,600, which of course is the same as the net assets. Day 7, the only thing that happens on day 7 is that we pay off some of the amount that we're owed. So our balance, our cash goes down, and our current liabilities go down by the same amount. It doesn't affect the total capital, it's just a change in the composition of the assets. And then day 8, the last day of this, we have an expense, so $300 of rent is paid. Now this gives an opportunity to illustrate the difference between gross profit and net profit. Gross profit is the amount that we sell for less the cost of those sales, $1,800 minus $1,200, the $600, which we've already seen as an increase in capital on day 6. But now we've got a rent item of $300, which reduces our profit to $300. And that's reflected in the balance sheet. The expense is reflected in a reduction in the cash balance of $300 from $15,400 to $15,100, which reduces our net assets by the same amount to $20,300. And our profit is reduced by $300 to $300, so that we have a profit now, a capital at the end of the day, of $20,300. Now obviously we need to introduce the second of our financial reports, the profit and loss account, in a proper format, so that gives an explanation, rather than having to work it all out from the balance sheet, of what's happened. Notice that the profit and loss account is for a period. This is of fundamental importance. A balance sheet is a statement at a point in time, on June the 8th. This is the situation in the balance sheet we just looked at on June the 8th. Whereas the profit and loss account shows all of the transactions and their impact on profits for the 8 days ended June the 8th. So we have only one sale for $1,800. Our cost of sales is the purchases less the closing inventory. We purchased $9,000 worth of inventory. We've used $7,800 of that figure that we've been told. which gives us the cost of sales of $1,200, which gives a gross profit of $600, less the rent of $300, gives us a net profit of $300. That is it. That is double entry. Now we will go on in Workbook 3 to see how you actually do that in practice using ledger accounts, but you could always do your double entry creating a balance sheet at the end of every day showing changes and using the profit and loss account to explain those changes. So that is the basis of double entry accounting. It's really important because everything else that we do builds on the basis of an understanding of double entry.